As of Monday, May 4th, 2026 at 11:34 a.m., Plug Power is trading live at $3.11 per share, showing a slight intraday dip of about 0.64% since the opening bell. While the broader indices are trying to find their footing this morning, Plug Power is caught in a narrow trading range between $3.04 and $3.18. On the surface, this looks like just another quiet Monday morning for a small-cap energy player. But beneath the surface, there is a massive tug-of-war happening between institutional short sellers and retail dip buyers. The expectation is that Plug Power is finally turning the corner toward its goal of positive earnings before interest, taxes, depreciation, and amortization by the fourth quarter of this year. However, the reality is that the company just made a quiet but massive strategic pivot by selling off its flagship green hydrogen site in Western New York to a data center developer. This isn't just a simple real estate deal. It is a fundamental shift in how the company views its own survival. By offloading what was supposed to be North America's largest green hydrogen plant, Plug Power is signaling that it might be abandoning the dream of being a primary producer in favor of being a pure-play equipment provider. For months, the market narrative has been built around Plug Power becoming a titan of hydrogen production, fueling a fleet of trucks and factories across the globe. But the reality of high interest rates and the second Trump administration's cooling stance on green energy subsidies has forced a hard reset. When you look at the recent trading volume, which has been hovering around 37 million shares, you see a market that is deeply divided. There is a specific curiosity loop here. Why would a company that spent years hyping up a mega facility suddenly sell it to a data center firm like Stream Data Centers? The answer lies in the immediate need for cash and the skyrocketing demand for power in the AI sector. While investors were waiting for hydrogen-powered trucks, Plug Power realized that the quickest way to stabilize its balance sheet was to pivot toward the data center boom. This is a classic case of expectation versus reality. The crowd expects a hydrogen revolution, while the management is quietly trying to survive a liquidity crunch by selling their assets to the highest bidder. If you are using investing sites or looking for investment help through platforms like Schwab Intelligent Portfolios or Fidelity, you've likely seen the volatility score for Plug remain off the charts. Institutional activity shows that while some major funds are trimming their positions, retail sentiment on platforms like the Robinhood app remains stubbornly bullish. Many self-investing traders are looking at the 52-week low of 69 cents and the high of $4.58, seeing $3.11 as a bargain entrance point. But looking at the individual brokerage data, the short interest remains a massive weight on the stock. For every investor who thinks this is a buy-the-dip moment, there is a hedge fund betting that the company will burn through its remaining $368 million in cash before it ever reaches profitability in 2028. This tension is what makes Plug Power one of the most dangerous, yet potentially rewarding, stocks in the current market. Let's talk about the recent momentum. Over the last month, this is 40% from its March lows. This was driven by a raised price target to $3.50 and news of a significant electrolyzer contract in Canada. But notice how every time the stock approaches that $3.50 level, it gets rejected. This is because the reality of the company's financial state, specifically its negative earnings per share of negative $1.42, acts as a ceiling. Even with the DOE closing a $1.66 billion loan guarantee, the market is skeptical about the execution. It's one thing to have a loan, it's another to build a profitable business model when the cost of producing green hydrogen remains significantly higher than traditional fuels. This is why the trading platform data from Interactive Brokers shows such heavy hedging activity. Smart money isn't just buying the stock, they are buying protection. Comment below how many shares of Plug Power you currently hold, or are you waiting for it to drop below $3 again before you consider an entry? When we step back and look at what this company actually does, the story gets even more complex. Plug Power isn't just one thing. They have over 74,000 Gen Drive fuel cell systems operating globally. They are the backbone of material handling for giants like Amazon and Walmart, where hydrogen-powered forklifts are a standard. Their Gen Eco electrolyzers are being shipped to 5 continents. On paper, the business model is solid. Provide the fuel cells, provide the hydrogen, and provide the service. But the execution has been plagued by delays and cost overruns. In the fourth quarter of last year, they finally managed to hit a positive gross margin, which was a huge milestone. Yet the stock barely moved. Why? Because the market has been burned by positive outlooks from this management team before. This is where the trust gap comes in. Investors who use SoFi Invest or Fidelity Wealth Management are looking for consistency, not just one good quarter. The future outlook for Plug Power hinges on 2 major catalysts.
First, the Q1 earnings report scheduled for May 11. This is the reality check the market is waiting for. If they can show that the cash burn is truly under control and the $275 million from asset monetization is hitting the books, we could see a squeeze toward the $4.50 level. The second catalyst is the shift toward the data center market. By selling land to data center developers and potentially providing them with backup power through fuel cells, Plug Power is tapping into a much more stable and well-funded customer base than rural trucking fleets. This is the pivot that could save the company, but it also means the original green hydrogen producer thesis is effectively dead. If you are using a Fidelity trading platform or the Robinhood mobile app, you have to realize that Plug Power is no longer a set-it-and-forget-it growth stock. It is a tactical play on the energy transition. The macroeconomic pressures of 2026 are very different from the speculative frenzy of 2021. Today, the market demands proof of profitability. The company says they will be fully profitable by the end of 2028. That is a long time for an investor to sit on a stock that is burning $500 million a year in operating cash. When you compare it to a titan like Nvidia stock or even the stability of Apple stock, the risk profile here is astronomical. Even compared to Tesla stock, which has its own volatility, Plug Power operates in a sector where the infrastructure is still being built from scratch. To wrap this up, the central insight here is that Plug Power is currently in a state of controlled contraction to survive. They are cutting the high-cost, high-profile projects like the New York plant to focus on high-margin equipment sales and the burgeoning data center market. The expectation is a slow, steady climb toward green energy dominance. The reality is a desperate high-stakes pivot to stay solvent long enough for the hydrogen economy to catch up to their technology. We are seeing a stock that is trying to base at $3, but it is doing so on a foundation of asset sales rather than product sales. This contrast between the management's optimistic messaging and the reality of their shrinking footprint is exactly what investors need to watch as we head into the May 11 earnings call. The authority of the Hydrogen King is being tested, and while the technology is proven, the business model is still very much in the experimental phase. Whether you are looking at Fidelity ETFs, browsing through Robinhood investments, or managing an individual brokerage account, the lesson of Plug Power is clear. Never mistake a vision for a balance sheet. The stock's live price of $3.11 reflects a market that is waiting for a reason to believe again, but is equally prepared to walk away if the next earnings report shows any sign of the old, undisciplined cash burn. The gap between expectation and reality has never been wider for this company, and the next few months will determine if Plug Power becomes a cornerstone of the new energy economy or just another cautionary tale of an over-leveraged pioneer. Keep a close eye on the volume and the institutional flow, because in this market, the noise is loud, but the cash flow tells the real story. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends. Bell subscribe for more updates.